Hi there, Daniel from the Southwest Florida Real Estate Channel. We're going to be looking at, I kind of squeaked there, we're going to be looking at different options for where to get financing. So what we're going to do is we're going to look at the difference between a mortgage bank and a mortgage broker. So we're going to start with a bank, okay? So one option is when you go to buy real estate, what you could do is you could go and talk to the place where you've got your account, so your savings and or checking account. So if you think of it like this, what's going to happen is you've got your seller right over here, and you got your buyer right over here, okay? And so what happens is the seller transfers their title, their ownership of the property, and they do that with a document called a deed, okay? Some people think that a deed, that means title. It does not. There's more than one type of document that can be used to transfer title to property, one of them is a deed. A deed is generally when the government is not involved and you've got a seller transferring ownership to a buyer, and neither of them is the government. There are different types of deeds, okay? Your standard deed that you probably want to have in the state of Florida is a warranty deed. The long term for that is the general warranty deed. What happens with the general warranty deed is the seller is signing, number one, and number two, they're taking complete responsibility for everything related to the past, the present, and the future. So what happens is in a general warranty deed, your seller is proclaiming basically that you'll have no problems. Now, is that a complete protection? Of course not. You still got to buy title insurance. You still want to record your deed down at the county, which whoever conducts the settlement for you, they'll do that. They'll charge you, of course, you pay for it, but they'll do that. So there's different types of deeds. You've also got something that's, think about general warranty deed, then you've got something called a limited warranty deed, sometimes called a special warranty deed. This is where a seller's not taking any responsibility for anything from the past, only their term of ownership. Then you got a quitclaim deed. I'll just tell you, if you're getting a quitclaim deed and you don't know why, turn and run the other way like your hair's on fire. Because a quitclaim deed is where the seller makes no promises, and the purpose of it is to eliminate title problems. There's other types of deeds where the seller is not signing, but those are the three basic types where the seller does sign. Seller takes a deed, gives it to the buyer. Buyer is going to sign a mortgage contract and also a promissory note, and these are the liability documents to the bank. In exchange for that, what's going to happen is the bank is going to take some money and give it to the buyer, and then the buyer is going to take that money and immediately give it to the seller. Okay. Standard commission split, by the way, related to the expenses when you sell property. If you've got a 6% listing, what's generally going to happen is that 6% comes out of the sale price. So if you've got a $100,000 sale, the seller gets $94,000 of it, $6,000 of it gets split four ways. What happens is generally you've got the listing brokerage and then their sales associate, and then the buyer's brokerage and their sales associate. So that $6,000 in this example would get split four different directions. And so what happens is this bank takes and gives the money. Bank sits here and waits 30 years to get the money back. So that's one option. If you go to a local bank, if you go to Suncoast, whatever, Southwest Florida Coast, whatever, some name Bank Iberia or whatever, that's what they're going to do is literally loan you their money. A credit union, by the way, not a bad idea. If you're not a member of a credit union, those are nonprofit organizations. You've got to join. A lot of times you can join for about $5, and you can open an account there. Credit unions are very good related to interest rates and low origination fees for car loans and all kinds of different loans, mortgage loans and whatever. So this is one option. But a lot of people, what they do is instead of going to their bank, what they're going to do is they're going to go to a mortgage brokerage. Okay, so I'm going to change this language here from the word bank, and I'm just going to say MLO. Mortgage loan originator is the name of a license. It's a national license. In other words, if you find somebody who's an MLO, they're licensed in Florida, they're actually licensed to be in all 50 states they can practice. The mortgage loan originator, what they're doing is they're actually getting the money from over here somewhere, some other source. So just think about like big banks, other giant banks. Technically what you've got is the biggest lender over here for residential financing is called Fannie Mae. It's a government-funded program, okay? And so what happens is if you've got a mortgage loan originator, you pay them an origination fee. So that origination fee, whatever it is, it might be a flat fee, it might be 1% of the loan amount. But what they do is rather than being a bank selling their own money where they've got limited products, and where the origination fee is going to tend to be low and the interest rate is going to tend to be a little bit higher, with a mortgage loan originator, what you're going to do is you're going to charge they're going to charge a higher origination fee, but they're going to go look at all these different products from all these different sources, and they're going to find a better interest rate for you in general. And so what happens now is the mortgage, that mortgage and that note, they continue on. They get sold over here, and then the money ultimately comes from there. And what you've got, if you've ever been in a situation where you were making mortgage payments and you paid one person one month, and then the next month you paid another person, and next month you paid another party, that's what's happening is they're taking the mortgage and the note and they're selling them and selling them and selling them. Now, that's just fine. That whole system crashed from 2006 and then ultimately in 2008, and it didn't work out very well. System is completely revamped now under what's called the Dodd-Frank Act, which is a federal legislation that completely changed the mortgage loan origination business. This used to be called a mortgage broker. You can't even be a mortgage broker anymore. The laws have completely changed. So anyway, the point being that you've got different types of financing. Credit unions are not a bad idea if you've got access to that kind of money. Mortgage loan originators, origination fee is going to be a little higher. Interest rate overall on the contract is going to probably be lower. When it comes to your bank, there are some practicalities there. The origination fee is going to be lower. Interest rate is going to tend to be maybe a quarter point around there higher. But what they may do is not ask you for so much paperwork. And if it's Wells Fargo, you can make automatic payments right out of your account every month, and you don't have to do that much, and that's worth it to some people. So those are some financing options.